Okay, dear students, first of all, welcome to everyone in our first live revision class of SBR, and this class is for the session 2026 September written. Okay, since it's a first class, so it will not be very long. But in today's class, I will explain what exactly we are going to cover in each and every live revision class, and I will be discussing the approach as well. But let us start from a very first IA 16, a quick revision. And student, if I'm not wrong, at least 3 to 4 days before the class, we have shared exactly all the IASs which we are going to cover in today's class. But don't worry, we are not going to cover each and every IAS which was mentioned in the group because it's a first class, that's why. Okay, IAS 16, property, plant, and equipment. First of all, student, when we say property, plant, and equipment, initially you have to recognize at cost. Initially, you have to recognize at cost. Now, subsequent expenditure, there are two possible subsequent expenditure. One is capital expenditure and another is a revenue expenditure. If subsequently you incurred a capital expenditure, then obviously it will be capitalized. If there is going to be a revenue expenditure, so we have to expense out. For example, maintenance is a revenue expenditure which we have to bear subsequently, so I have to expense out that. But if in a, let's say in a particular owner occupied building, if you add a new story into that, that is a capital expenditure, so I have to capitalize that capital expenditure. Okay, now important concept is initially we have to recognize property, plant, and equipment at cost, but subsequently, students, subsequently IAS 16 gives us two options. Not initially. Initially, you have to recognize property, plant, and equipment at cost. But subsequently, you have got two options. One, you can still keep following the cost model. And the second is revaluation model. Repeat. Initially, you have to recognize property, plant, and equipment at cost, but subsequently you have got two options. Either you can keep the property, plant, and equipment at cost model, or you can go for a revaluation model. But should now listen carefully. IAS 16 gives you the options. Cost model, another is revaluation model. Now listen, whenever you have been given more than one option, logically that thing is your accounting policy, because accounting policy is something which gives you right to choose. Accounting policy actually gives you right to choose. So obviously it is up to your company. Either subsequently you still want to keep your property, plant, and equipment at cost model, or you want to go for a revaluation model. But an important concept is you can choose any one of them. That is going to be your accounting policy. So wherever the term accounting policy comes from here onwards, you should keep one concept in your mind, and that concept is accounting policy actually gives us right to choose. Another concept, if your company says that we want to keep property, plant, and equipment at revaluation model, then you are not supposed to revalue only a single asset. If you really want to go for a revaluation model, then all the assets within the same class, you have to revalue all of them. Repeat. If your company chooses a revaluation model, okay, then you have to apply the revaluation model for on all the assets within the same class. Okay, now come here kindly. Property, plant, and equipment initially recognized at cost. Subsequent expenditure on non-current asset may be capitalized if it enhances economic benefit of the asset. For example, adding a new wing to a building. We have discussed this. Another point is replaces part of an asset that has been separately depreciated. So In that case, let me give you the example. Assuming, let's talk about an aeroplane. If within the aeroplane, I'm replacing the cabin fittings. So obviously, previous cabin fittings I will dispose of, I will de-recognize, and the new cabin fittings I will capitalize. Okay. Replaces economic benefit of previously consumed asset. Major inspection of the aircraft will be capitalized. Asset is depreciated over its useful life. Now, this is important, students. Asset is depreciated over its useful life. Actually, the question is, what is a useful life? Let's say ABC company, they are buyer of a property, plant and equipment. Okay. And ABC company decides that we will be using this property, plant and equipment for 5 years. ABC company they have decided that we are going to use this property, plant and equipment for 5 years. So this 5 year becomes the useful life. Now listen, at the end of 1 year, if ABC company says instead of 5, we'll be using this property, plant and equipment for 10 years, then there is going to be a change in useful life of the asset. If after 1 year or maybe after 2 years, ABC company says, okay, instead of 5, we'll be just using this property, plant and equipment for 4 years. Again, it is a change in useful life of the property, plant and equipment. The main concept is, if your organization brings a change in the useful life of property, plant and equipment, so change in the useful life of property, plant and equipment is treated as change in estimate. Change in useful life is treated as change in estimate. Now listen, students. Change in estimate is applied prospectively. Means the year in which you have bring the change, from that year onwards, you will follow the new. According to the new estimate, you are going to depreciate your property, plant and equipment. The main concept is, useful life itself, it is an estimate. It is not the accounting policy. Useful life is an estimate. When I'm saying, for example, just an example, okay? Your family bought a new car, and initially your family has decided we'll be using this car for 10 years. There's a possibility after 2 years or maybe after 3 years, your family says, now we'll be using this car 1 more year, and after that we are going to sell this car to get a new car with a better technology. So actually, the estimated useful life is the useful life of property, plant and equipment is an estimate, number one, and change in estimate is applied prospectively. Okay. And according to which IAS students we have to apply change in estimate prospectively? Is there anyone who can give the reference of that IAS? Okay, let me make it more easier for you. Which IAS says change in accounting policy you need to apply retrospectively, and which IAS says, okay, let's see. Students, which IAS says change in estimate is applied prospectively? Come on, come on. Yes. IAS 8, students, IAS 8. I was not expecting such different answers. Okay, now listen, students. Your family bought a car, okay, and this car is good enough to use for 50 years. How many years? This car is not going anywhere for the next 50 years. But your family has decided we will be using this car for 10 years. So student, my question is, which one is a useful life? 50 years is a useful life or 10 years is a useful life? Repeat. Your family has bought a car which has an economic life of 50 years, means that car is not going for anywhere for 50 years, okay? But your family has decided we will be using this car for 10 years. So my question is, what is useful life for your family? Is it 50 or 10? Kindly reply in the chat box. Is it 50 or 10 years? It is 10. Now, obviously, after 2 years or after 3 years, your family can say, okay, we'll be, instead of 10, we'll be using this car for 15 years. There's one more possibility. After 2 years, your family might decides that instead of 10, we'll be just using this car for 5 years. So such a change is a change in estimate, and change in estimate is applied prospectively. Okay, now come here. The depreciation method, number one, useful life on your asset should be reviewed at the end of each year. Depreciation method and useful life on your estimate should be reviewed at the end of each year. Now listen, students. Depreciation method, now this is also very important. Now try to understand the concept. Number one, according to IAS 16, depreciation method should match with the pattern of economic benefit which your company will be getting from that property, plant, and equipment. Repeat. Depreciation method should match with the pattern of economic benefits which your company is going to get from the property, plant, and equipment. Now the question is, what do you mean by pattern of economic benefits? Now listen to me carefully. If your company will be getting, let's say, more or less same benefit every year, if your company is going to get same economic benefit every year, in that case, student, you should be using your depreciation method should be straight line. You should be using a straight line method for depreciation purposes. You should go for a straight line. But if your company believes that since the asset is new, let's say your company has bought a machinery, okay, plant and machinery. Your company says it is a new plant and machinery. Initially, the performance is going to be very high, but later on, with the passage of time, its performance will deteriorate. So it means initially that asset is going to give us more economic benefit, but later on that same asset will give us less economic benefit. If this is the case, your company should go for written down value method. Another name is reducing balance method. Great. Let me repeat the example for you. Let's say your company has bought a new plant and machinery, and the company says since the plant and machinery is new, so initially this plant and machinery is going to give us more economic benefits, but later on the same plant and machinery will give us a reduced economic benefit. In that case, your company should be using reducing balance method. Another name is written down value. Now, a very important point, students. Listen it nicely and give me the answer. According to IAS 16, depreciation method should match with the pattern of economic benefits. If you are getting same economic benefit more or less every year, you should go for a straight line method. Initially, you will be getting more economic benefit. Later on, you will be getting reduced economic benefit. Then you will be going for reducing balance method. Another name is written down value. Now listen to me carefully. The question is, if there is a change in the pattern of economic benefits, of course, if there's going to be a change in the pattern of economic benefit, you have to change the depreciation method. My question is, change in depreciation method. Change in depreciation method. Number one, should I treat this as change in accounting policy? Or second, should I treat this change in accounting estimates? Kindly reply and give me the reason as well. Okay, let's see what is the answer. Oh, one student is saying change in accounting policy. Okay, now listen to me carefully, students. Then you will get to know the answer also. Try to understand. According to IAS 16, your depreciation method should match with the pattern of economic benefit from the asset. If you are getting same economic benefit, you should go for a straight line method. If initially you will be getting more economic benefit from plant and machinery, let's say, and later on, I would say reduce economic benefit, you will go for reducing balance method. Can I say, did I say in the entire explanation that you have an option? It is up to you, go for a reducing balance method or go for a straight line method. IAS 16 does not give you choice, does not give you the choice either to go for reducing balance method or for a straight line method. Try to understand what IS says. IS says your depreciation method should match with the pattern of economic benefit. Where is the option? IS is not giving me the option. IS is not giving me the choices. I said whenever you come across a situation where you are getting a right to choose, that is accounting policy. Here we do not have a right to choose. Here we have to listen to IS. IS says depreciation method should match with the pattern of economic benefit. So where is the choice? I don't have a choice. So logically, student, change in depreciation method is change in accounting estimate. It is not change in accounting policy. Is that clear now? It is change in accounting because we don't have options here. It is not up to us either go for a straight line method or a reducing balance method. No. IAS 16 says something else. IAS 16 says your depreciation method should match with the pattern of economic benefit. For example, we have got an owner occupied building. Okay. We have got an owner occupied property. And let's say more or less we are getting the same economic benefit. I'll be depreciating that building by using straight line method. I bought a new plant and machinery, so I know that initially I'll be getting more economic benefit. Later on, I'll get reduced economic benefit. If this is the case, I'll go for reducing balance method. If there is a change in economic pattern of economic benefit from the asset, I have to bring a change in my depreciation method. Change in depreciation method is change in estimate. And change in estimate is applied prospectively. Kindly look at this. The depreciation method and useful life of an asset should be reviewed at the end of each year. If an asset parts with different lives, for example, building with a flat roof, the component parts of the asset should be depreciated separately. Basically, here is a concept of componentization. Now, what is the meaning of componentization? There is a possibility that particular asset might be the combination of multiple components, where each component is having a different useful life. If each component is having a different useful life, in that case, you will have to depreciate each component separately. Like take an example of aeroplane. Let's say if your examiner says interior cabin fittings, they are having a useful life of 10 years. Okay. An examiner says exterior structure is having a useful life of 20 years. So then I'm going to depreciate one component on over 10 years, another component over 20 years. So in case of the concept of componentization, where your asset is the combination of multiple components, where each component is having a different useful life, then each component will be depreciated separately. Revaluation of property, plant and equipment. Revaluation to fair value is, look at this, students, please, optional. Wherever the term optional comes, then you should be thinking about accounting policy, because accounting policy gives you the option. Other than accounting policy, you will not get any options from any other area. Okay. Revaluation to fair value is optional, means you have a right to choose. If one asset is revalued, now this is important. All assets in that class must be revalued. All assets in that class must be revalued. Revaluations gains are credited to other comprehensive income, OCI, unless the gain reverses a previous revaluation loss of the same asset previously recognized in profit and loss. There's a possibility. Now try to understand. Let's say we are having a property, plant and equipment. Carrying amount is 100 million. Let's say useful life is 10 years. Depreciation, let's say 100 divided by 10, it is 10. It's the first year, let's say. Then property, plant and equipment, it was 1/1/2026. Property, plant and equipment carrying amount on December 26. Can I say December 26, it will be 90? Now listen, if the company says we want to follow a revaluation model, let's say on December 2026, examiner says revalued amount is 120 million. So case A, what to do with this 30 million? This 30 million is logically a revaluation surplus. This 30 million is a revaluation surplus, and this 30 million revaluation surplus will go to OCI, other comprehensive income. Debit, credit, double entry, your property, plant and equipment logically will increase by 30. Revaluation surplus OCI, other comprehensive income, will be credited by 30. Okay, now scenario B. Let's say on December 2026, carrying amount, we know that is property, plant and equipment carrying amount is 90, and that 90 does not have any impact of revaluation. It is the first year, and at the end of the first year, the carrying amount is 90. Assuming revalued amount is 75 million. Now try to understand, students. Instead of rise in the value of the asset, we are witnessing a decline in the value of an asset. And previously, this 90 does not have any revaluation surplus. Logically, this 15, we will take this 15 as an impairment expense, impairment loss. And logically, this 15, since 90 does not have the impact of 90 does not include any revaluation surplus, so this 15 will directly go to profit and loss. That will go to statement of profit and loss. Okay, now let me give you a little idea about IFRS 18 as well. Now we know that IS1 is no more applicable in ACC. ACC has adopted IFRS 18 for presentation and disclosures. And plus we know that compulsory application of IFRS 18 is from 1st January 2027 onwards, but ACC has adopted IFRS 18. Now, due to IFRS 18, you have to follow all the presentation according to IFRS 18. Now, listen. The biggest impact of IFRS 18 presentation and disclosure you will see and you are going to witness, that is on profit and loss. Now, after IFRS 18, we will be preparing profit and loss. Within the profit and loss, there will be 5 categories, 5 sections. One is going to be operating category, or you can say operating section. Another is going to be investment section, financing operating category, investment category, financing category, income taxes category, and discontinued operations. I always say discontinued operation and income taxes category, they're not difficult at all. Now let's talk about operating. Now listen. Depreciation expense, which is 10 million in our example. Previously, when IFRS 18 was not there, we used to say only one thing, that depreciation expense will be charged to P&L, which is perfectly fine. But now it is not acceptable. Now, when you will be saying that depreciation expense will be charged to the P&L, you have to mention the category as well. Yes, it will go to P&L, but under operating section, you have to mention the category as well. Now, the category is going to be operating. Okay. If part B, there's an impairment loss of 15. Yes, this impairment loss of 15 will go to P&L. But if you ask me the section, I'll say that will go to operating category. So there's a possibility that we are revaluing the asset. There's a rise in the value. Then it is a revaluation surplus. Revaluation surplus actually goes to OCI. If we are revaluing the asset first time, that is part B, and instead of rise, if there's a fall in the value, that fall in the value is your impairment expense, impairment loss, and this impairment loss will go to P&L under operating category. We have to show under operating category. Okay. Then there is a possibility that after 1 year or 2 years, company might experience a reversal in the impairment loss. if the reversal in the impairment loss comes, how to deal with that? We are going to revise that. Don't worry at all. But under IAS 36. And one more thing, not now, just I want to give you one idea, little idea. Where's the revaluation surplus? We know that 30 million revaluation surplus there will go to OCI. The double entry is in front of us. 30 million property, plant and equipment debit, revaluation slash OCI credit by 30. But then later on, when we'll be revising in the coming classes as well, you will see that we will be discussing one more thing, that due to this revaluation surplus, deferred tax liability will be created. And that double entry of that deferred tax liability will be revaluation slash OCI will be debited and deferred tax liability is going to be credited. So obviously later on we'll be revising this also, that due to IAS 12 income taxes, this revaluation surplus actually results in a deferred tax liability, and that double entry of that deferred tax liability is revaluation surplus slash OCI will be debited and deferred tax liability will be credited. But right now we are not discussing that. Don't worry at all. Come here. Revaluation losses are charged to the statement of P&L unless the loss related to the previous revaluation surplus, in which case it will be charged to OCI. Revised carrying amount is depreciated over the remaining useful life of the asset. Look at this. An entity may choose to make a reserve transfer for excess depreciation arising from the revaluation. This is taken from the revaluation surplus to the retained earning. I'm going to explain this numerically, but before that, student, kindly look at this. An entity may choose. After that, whatever is written, leave that. What does this may choose means? Will it be accounting policy? Yes or no? Kindly reply. The term choose, does it refer to accounting policy? Kindly now reply in the chat box. I'm waiting. Look at the term choose. After choose, whatever is written, that is not my concern right now. Yes, it is accounting policy. Wherever the term choose comes, it is going to be your accounting policy. Now, let me explain that numerically, what exactly IAS 16 is saying here. Let's come here. Let's say, stay with the part A. Assuming property, plant and equipment is 90, revalued amount is 120. There's a revaluation surplus of 30. The double entry is property, plant and equipment debit, revaluation surplus credit. Okay. Now, after revaluation, you will be depreciating the asset over the remaining life. Repeat. After revaluation, you will be depreciating the asset over the remaining life. After revaluation, you will be depreciating the asset over the remaining life. Now listen. 2027. Keep that part A in your mind. 2027. Depreciation expense. Revalued amount is 120. Now the remaining life is 9 years. Initially it was 10. It was 10 in 2026. Obviously now it is 9. Let me use the calculator. 120 divided by 9. Students, I'm getting 13.33 depreciation expense. Okay. We know that this depreciation expense will go to P&L. So under which section? Kindly give me the name of a section. Should I take this 13.333 to the investment category or operating category? Kindly reply. Should I take this 13.333 depreciation to operating category or investment category? Operating, excellent. Thank you. Operating is the right answer. Excellent. Okay. Now try to understand. We have calculated the depreciation and the depreciation is 13.33. After that, there's no need to do anything. If you don't want to do it, it's okay. But there's one more possibility. What is that? Try to understand. Without revaluation, the depreciation was 10. After revaluation, if you look at this, depreciation has increased. Previously, it was 10. Now it is 13.333. How much additional depreciation we are having? We are having 3.333. This is our additional depreciation. Now listen to me. According to IAS 16, it is up to the company that you can do one thing. You can slowly and gradually, you can transfer revaluation surplus to the retained earning. But that is going to be your accounting policy. It is optional. It is not compulsory. Repeat. After revaluation, you will witness that there is going to be a rise in the depreciation. According to IAS 16, you can choose one thing. If you want, you can slowly and gradually transfer the revaluation surplus to the retained earning. How to transfer the revaluation surplus to the retained earning? Let me explain that. The term which we use is, that is, realize to realize. Just a minute. Realization of revaluation to retain earning. What are we doing? Your revaluation surplus is 30. Take the revaluation surplus divided by remaining life. Revaluation surplus divided by remaining life. Look at this. We are directly getting the same value. What are we doing? We are realizing that revaluation surplus. Realizing the revaluation surplus means we are simply converting that revaluation surplus to the retained earning. Double entry is going to be very interesting. If someone asks you what is the double entry of realization of revaluation surplus, look at the double entry. Revaluation surplus slash OC, other component of equity will be debited. You are not supposed to debit OCI. Incorrect. Absolutely wrong. You are not supposed to debit OCI. You are supposed, if you want to debit, you can debit revaluation surplus slash other component of equity. Credit is going to be retained earning. This is what are we doing? We are simply slowly and gradually, we are realizing the revaluation surplus. We are slowly and gradually transferring revaluation surplus to the retained earning. But now listen to me carefully. It is not necessary that you have to realize the revaluation surplus. It is not necessary. It is an optional thing. It is up to your company. Either you want to realize the revaluation surplus or you don't want to realize. Because slowly and gradually, if you're not realizing, no problem at all. And when the time of disposal comes, then on the date of disposal, the entire revaluation surplus will be realized and it will be transferred to the retained earning. Otherwise, you have got another option. Another option is slowly and gradually you can simply realize the revaluation surplus. Now listen to me carefully. Logically, revaluation surplus, other component of equity, debit, retained earning, debit, credit. Try to understand one thing. Logically, if you look at this, we are debiting one component of equity and we are crediting another component of equity. So overall on equity, there is no change. Total equity will remain same. Repeat. Logically, we are debiting one component of equity and we are crediting another component of equity. So overall total of the equity will not change. But you can say something. What is that? You can say one thing that actually that is understood that overall there's no change on the total equity. But you can say one thing, that company is transferring undistributable reserves to the distributable reserve. Retained earning is a distributable reserve. Revaluation is a undistributable reserve. So another interpretation which could be given to this double entry is by realizing the revaluation surplus, company is converting undistributable reserve to distributable reserve. But you don't forget one thing. Logically, revaluation surplus will be equal to the excess depreciation. Where is that excess depreciation? Now, after revaluation, we are going to charge depreciation expense under operating category to the P&L 13.33. Previously, without revaluation, the depreciation was 10. So you can see that revaluation realize is equal to that additional depreciation, but I'm repeating it again. Realizing the revaluation surplus, it's not necessary. It is, it is up to your company. Either you want to follow this accounting policy or you don't want to follow. Okay. Now, let us see quickly IAS 20 government grant. Or student, don't forget one thing, it's a live revision class. Okay, I'll be focusing on the main area of that IAS as well as IFRS, because we are not supposed to spend the same amount of time which I have spent in my regular classes. In regular classes, it takes around, I would say, around 2 classes, if I'm not wrong, to complete that IAS 16. One class is again is going to be, I think around it is 40 to 45 minutes long, not more than that. So might be 3 classes exactly. I'm unable to recall it, but it's a revision class. So obviously we'll be just focusing on the main area of each and every IAS and IFRS. One more thing. Initially, we'll be revising ISS and IFRS, but after maybe just 3 more classes, we will start the discussion of live. In the live revision classes, we will be then we are going to discuss SBR recent past papers as well. And at least 3 to 4 days before the class, I'm going to share the questions which we will be discussing in our live revision class. So within these live revision classes, you will not only be having a revision of ISS and IFRS, you are going to get the revision of, inshallah, recent past papers as well. But before I'm going to discuss that those questions in the class, at least 3 to 4 days before the class, I will share 1 or 2 questions, whichever is I'm going to line up, so that you can have around 3 to 4 days to attempt that question. But within these live revision classes, you will see the discussion of recent past papers as well. Okay. IAS 20 government grant. Grant should not be recognized until there is a reasonable assurance. Now, let me tell you one thing, students. No IAS, no IFRS will give you what exactly that. What do you mean by reasonable assurance? It is something which is, I would say, something which is which comes with the experience. For example, ABC company has one meeting with the government or maybe with XYZ government department. Within 1 or 2 meetings, you will automatically get to know either your company is going to get the grant or not. This is something which I would say, if you ask me, I would say even in a very first meeting, you will normally you are going to get the idea either your company is going to get the grant or not. So main concept is, if it is reasonable, there's a reasonable assurance that company will be getting the grant, only then you will recognize the grant. Otherwise, you are not supposed to recognize the grant. Grant will be received and the conditions will be compiled with. Income grant. Now listen, students, there are 2 types of government grant. One grant is a revenue nature grant. Another name for the revenue nature grant is an income nature grant. Now listen to me carefully. Income nature grant or a revenue nature grant is a grant which actually relates to an expense. For example, your company might have started a factory in a village and the government has appreciated your action, and the government has decided that in 2027, whatever wages your company is paying, 50% will be paid. 50% of wages this time government is going to pay. Such type of grant is an income nature grant or an expense nature grant. Initially, of course, income nature grant is recognized as deferred income. Subsequently, you have got 2 options. One, you can subsequently, when you have recognized the wages expense, you can separately recognize the grant income, or instead of recognizing a grant income, you can show your wages expense net of grant. What do you mean by this? For example, The amount of the wages is 100,000. In 2027, 50% of the wages, who will pay? Government will give you the 50% of the wages. Initially, the double entry is going to be when it is reasonable, when there is a reasonable assurance that your company is going to get the grant and conditions you are going to meet. Let's say either you have received the grant or government grant receivable, debit by 50,000, then deferred income, credit by 50. Now listen. Now there are two possible options for you. One, at the end of the year, you show separately in the P&L wages expense 100,000. Then convert that deferred income into income. What will be the double entry when I'll be converting deferred income to the income? Simply deferred income debit by 50,000 and grant income credit by 50. Then in the P&L, I'm going to show separately wages expense 100,000 and grant income as other income 50,000. Okay. Or instead of this, you can directly show the wages expense 50,000. Option A. Then we are saying no. Deferred income 50. And let's say grant income or other income 50,000. Or instead of this, in this case, in the P&L, you will see a wages expense 100,000 separately. What will be the double entry of that wages? Simply wages expense debit by 1 lakh, bank cash credit by 1 lakh. Or another option is deferred income debit by 50. Initially, deferred income was credited. Now I have debited, so the deferred income is over. Wages expense simply 50,000 because we are paying 50. 50 is coming from the government. So bank 1 lakh. So both options are acceptable. You can choose any one of them. As soon as I said choose any one of them, it means it's going to be your accounting policy. That is how to deal with the revenue nature grant or a capital nature grant. Another, let's say scenario. For example, I'm just giving you the example, okay? Let's say, just an example, that this 50,000 grant relates to a particular expense. In 2027, your company has received the grant of 50,000 pound, $50,000, but a particular expense you have incurred only 80%. If particular expense you have only incurred 80%, then whatever treatment A or B you want to follow, you will apply that treatment on 80% of the on the grant. Because if that particular expense is incurred only 80%, then let's say I want to convert my grant into income. I cannot convert 100% of the grant to the income. I'll be converting 80% of my grant to the income. So that grant should match with the percentage of the expense. If entire expense which I was supposed to incur, I've incurred the entire expense, then I'll be converting entire government grant into income if I follow that treatment. Another grant is a capital nature grant. Now, students, listen to me carefully. Capital nature grant is a grant which relates to a fixed asset. Grant for the purchase of non-current assets should be recognized over the expected useful life of the related asset. There are two acceptable accounting policies for this. Deduct the grant from the cost of the asset and depreciate the net cost, or treat the grant as deferred income and release to the statement of P&L over the life of the asset. So when it comes to capital nature grant, again, you have got two options. One, you can deduct the grant from the cost of the asset and depreciate the net cost. Or treat the grant as deferred income and release to the statement of P&L over the life of the asset. So slowly and gradually, when you will be depreciating the asset, then you will be simply amortizing the deferred income into and converting through amortization. We will convert that deferred income to the income. So students, that was a very quick, I would say, a revision of IAS 16 and IAS 20. I really wanted to do other IASs as well, but since it is a first class, so I don't want my first live revision class to be very long. But students, from the next class onwards, the duration of the class will increase. And one more thing, students, please from here onwards, each and every message which ASA admin is going to share in your relevant WhatsApp groups, kindly do not ignore those WhatsApp messages, because in those WhatsApp messages, everything is for you, for your benefit. We keep guiding you. Okay, now you have to do this, now you have to do this. So kindly, it's my humble request, do not ignore any message which is coming from admin in your relevant WhatsApp groups. So day will remain same, Sunday, every Sunday, once in a week, but the duration of the class will definitely increase. So thank you very much that you people have taken out time for today's class. And let me tell you, we are conducting these live revision classes in each and every ACCA papers. So if there is any question you want to ask before I end the class, you have 1 or 2 minutes. Students, each live revision class will be uploaded on the portal. Each live revision class will be uploaded on the portal. Is that clear now? Yes, you will be getting of course, you will be getting a live revision class with the notes, which I'm using right now. Otherwise, these short notes are already available, also available on the portal. So student, if in case you are unable to take the live revision class, recording of the live revision class, number one, it will be uploaded on the portal, and second, obviously it is available to all the enrolled students. So student, do give the feedback, kindly do give the feedback about live revision class in your relevant WhatsApp group. Thank you very, very much. Okay, there's one question, kindly ask. Let me pause the video. You can ask the question. I'm available.